Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Tom Evans, a private equity M&A partner in Latham & Watkins' London office. In this episode, we discuss the expanding environmental, social, and governance, or ESG, toolkit for European private equity. I'm joined today by Anne Mainwaring, an associate from our London office. Anne is a member of the firm's Financial Institutions Industry Group and specialises in ESG financial services regulation. Thanks very much for joining me, Anne.
Thanks so much for having me, Tom.
I'm really interested to find out more about the developments discussed in the piece that you co-authored in Latham & Watkins PE Views entitled ESG Toolkit Expands for European PE. It feels like talk of ESG considerations is everywhere at the moment. What are you seeing?
Absolutely, Tom. I'd completely agree with that. It's the combination of a rapidly developing ESG regulatory reform agenda, plus the ever-growing commercial imperative that's attached to ESG, which is driving an increased focus on ESG at both LP and GP levels across Europe, but also globally as well.
Great. How is the prominence affecting PE deals, Anne?
So the key headline here is that the market is showing demand for enhanced diligence, and a wider range of deal provisions are being considered in light of their potential to enhance the ESG outlook of PE investments. We're also seeing the occasional positive covenant on management teams in their incentive arrangements, requiring them to consider ESG matters. But the key point that I want to draw out here is that from a regulatory perspective, this is a more complex area than is often appreciated, and there's a growing bank of regulation that is developing.
Got it. Let's come back to the regulatory point, Anne. But for the moment, you mentioned demand from acquirers for enhanced ESG due diligence. What have you been seeing?
Yeah, that's right. So buyers are very much focused on key themes, including climate change, supply chain issues, and that includes things such as human rights, modern slavery. And then also we're seeing focus on matters such as diversity, data privacy, and governance as a whole. And then, as I say, we do also have the regulatory overlay. So, for example, in Europe, regulations such as the SFDR, that's the Sustainable Finance Disclosure Regulation, are broadening the disclosure and transparency requirements in relation to ESG matters. And what this actually means in practice is that firms in scope need to actually make sure that the ESG credentials that are being held out in respect of a PE fund are actually being attained in practice through individual investments. And of course, diligence therefore plays a key part in achieving this.
Okay, so let's go into the SFDR a little bit. And what is it, and how does it apply to private equity funds?
It's a good question. So let's start by just stepping back a little bit and thinking about what SFDR actually requires. And the key thing that SFDR does is requires firms that are in scope to classify their funds in one of three ways. So the first classification is what is referred to as an Article 9 fund. So that is a fund which has sustainable investment as its objective. Then the second classification is what's referred to as an Article 8 fund. So that is a fund that promotes environmental or social characteristics. So it's not quite as high on the scale as the Article 9 fund, but you still have those E or S elements. And then the third classification is what is referred to as Article 6, and that is all other funds. So essentially funds which are not meeting either the criteria of having a sustainable investment objective or of promoting environmental or social characteristics. So bringing this back, how does this actually impact in a PE context? Well, GPs are, depending on their structure, likely to be subject to these classification rules if they are either based in Europe or if they are marketing into Europe.
Hey, so what happened to Article 7, Anne?
I have been asked that before. So Article 7 is not part of the classification criteria.
Right. So practically speaking then, so you're classified as an Article 8 or Article 9 fund. What does that actually mean in practice?
What it actually means is that then you are holding that fund out as either having a sustainable investment objective, or you are holding that fund out as promoting a particular environmental and or social characteristic. And what that means is that enhanced ESG due diligence then becomes a key part of your obligations in terms of discharging your own obligations under SFDR to actually attain those ESG credentials that you have promoted based on the label attached. And failure to do so risks potential greenwashing, litigation, reputational, and other risks because you would be failing to comply with your own regulatory obligations.
Okay. And so we've been talking about GPs. Does it also apply to LPs, Anne?
That's absolutely right. So LPs can also be subject to these rules, again, depending on their structure. And that is, of course, another factor which is driving the increased focus on ESG diligence within the acquisition and life cycle monitoring. And the other angle on this is that LPs may also need the information on the ESG credentials of the fund in order to discharge that LP's own regulatory obligations itself in relation to ESG. And of course, let's not forget that, irrespective of the regulatory considerations, LPs, given their status, for example, as a visible pension fund or as a state related entity, for example, may well already take an enhanced approach to ESG compliance.
Interesting. And that ties in with one of the other key themes discussed in your article, which was reporting. Is the trend of greater data availability and disclosure in the market increasing the level of scrutiny from LPs in relation to ESG?
Yeah, absolutely. And that is actually the ultimate aim or the ultimate goal of what the legislation is trying to achieve. So its kind of ultimate underlying purpose is to facilitate the objectives of the Paris Agreement, including to reorientate capital flows towards more sustainable investment. So the idea is that by providing greater disclosure and transparency in relation to ESG matters, that enables investors to make more informed decisions about where they are putting their money from an ESG perspective. And I think, the key point to keep in mind is that this scrutiny is only going to increase as the regulatory landscape develops. We've got quite the pipeline of disclosure and transparency focused regulation coming down the track in the EU and the UK. And I think, the taxonomy regulation, which took effect in January, is a good example of this.
And for those less familiar with ESG matters, what is the taxonomy regulation? I'm assuming it's not something that you learn in a biology class.
It's different but connected to SFDR. So it's different in that what the taxonomy is trying to do at its core is deal with the issue that ESG can sometimes be a bit of an alphabet soup. By that, I mean that there are lots of different ESG terms which are used very frequently, but there's no consistency in relation to what those terms actually mean and how you define them. Therefore, what the taxonomy aims to do is create a consistent lexicon to determine when an economic activity can actually be classified as environmentally sustainable.
So this is like having the organic mark on your food in the supermarket means something.
Exactly, and you hear people use that terminology to help describe what these various initiatives are trying to do, such that, when you see a particular label in the supermarket, you trust that and you know that you would look for that to help you buy something. It's the same, but in the ESG context. So in terms of how SFDR and taxonomy are connected, key point here is that both GPs and LPs that are in scope of SFDR will be subject to enhanced disclosure obligations under the taxonomy. So essentially what the taxonomy does is it requires disclosure on either the extent to which the investments underlying the fund are taxonomy aligned, or you have to disclose that you are not considering the taxonomy. So key piece of disclosure and transparency legislation. But the other point, as I already alluded to, is that it's important to keep in mind that it's not just the changes at EU level that will impact firms. ESG is, of course, a global transition, and firms need to consider the changes relevant in all jurisdictions in which they operate. And as I say, a good example is the UK is now starting to develop its own ESG regulatory agenda with ESG-specific rules coming through.
Let's talk about that for a little bit. And what's the UK doing?
In the UK, we've got new rules on disclosure reform, which are intended to capture PE firms in certain circumstances. And those require annual entity and fund level disclosures against certain climate-related metrics from 2023 or 2024, depending on the size of the firm. And then in addition to that, the UK FCA is also going to consult on a sustainability disclosure requirements and investment labels regime, which will overlap with the EU SFDR regime. And in addition, we're also going to get a UK green taxonomy, which takes its principles from the EU taxonomy, but it will also be different as well because the UK will introduce its own criteria for the specific methodologies to be able to determine whether an economic activity is environmentally sustainable. So lots going on the regulatory front.
Crikey, you weren't kidding when you said it was more complex than often appreciated.
So that's absolutely right. So there's a lot of technical detail to wrap your head around, but the direction of travel is clear. And that is that there is a lot more focus when it comes to ESG. There is more diligence to do, and there is more reporting to verify what's being said.
Interesting. So we've talked about the fund level reporting and other obligations. We've also talked about M&A due diligence. I guess, what are we seeing in M&A deal documents? So ESG terms starting to creep in there?
Yeah, so it depends where you are in terms of the deal-making process. Access to ESG-linked financial products and loan facilities has become more widespread in recent years, which provides greater opportunity for PE sponsors to obtain capital on favorable terms if certain ESG-specific targets or conditions are met.
Understood. But so far, in M&A terms, have we seen the percolation of ESG concepts into sale and purchase agreements, documents used to take companies private, for example?
So we're seeing, for example, where people are linking ESG-related performance metrics, so the UN Sustainable Development Goals, to employee remuneration. We've seen that in publicly listed companies. And on suitable PE deals, we have seen early interest in ESG-linked terms, such as ratchets, but nothing more substantive as yet.
So, and it seems the takeaway is that while currently uncommon for PE deals, it seems like the most likely area for ESG terms to play a role is in setting performance targets for things like earnouts or management incentives.
Absolutely. As with many things, it's a balancing act. So deal teams need to continue to balance the demands of regulators, investors, sellers, and other stakeholders, particularly given the highly competitive, seller-friendly market across much of Europe and the US. However, these developments do represent a positive opportunity to move towards a more holistic approach to tackling ESG matters on transactions.
Well, it's been fantastic speaking with you, Anne. Thank you very much for joining me to speak about the expanding environmental, social, and governance toolkit available for European private equity.
Likewise, and thanks very much for having me, Tom.
Thank you. And thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope that you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.